Right. So it's 1 p.m. We're going to go ahead and get started. Thank you, everybody, for stopping in today into our webinar. Today, I wanted to cover a little bit of credit issues, things that we see often on our end as a lender, and things that are also that, we can work around when it comes to credit issues and things like that. So that's our main goal today. Just want to clear up some of the confusion on credit issues that borrowers may face, whether clients are ready to buy today or they just need some coaching. I'm hopeful that with all these tips can help as many people as possible sort of like get on track with their credit. So we're going to go ahead and get started. Well, first of all, one of the most important messages that I can truly deliver today is that credit score is really nothing to be ashamed of. Life happens and, we sort of have to like deal with it, right? So this is why it's so important to really counsel our clients regarding credit issues and just really being upfront and honest with them, because we don't want a client paying too much in mortgage interest over a credit issue that can be worked through very quick. So that's one of my goals today, is just trying to cover those bases and how we can help clients sort of like improve that credit score to get the best deal possible when it comes to the lending side. All right, so let's jump into how credit affects that interest rate. So when lenders assess the rate, they're looking at the risk, right? So that's why the interest rate is truly a reflection of that risk for the loan. It's not based on a guess or because the banks feel like it. The agencies and investors that purchase the mortgage loans, they have studied the loan performances, which leads to what's considered the level of risk on a particular client. So that's what really affects those rates directly. Generally, lower the credit score, the higher the interest rate, but also the higher the credit score, the lower the interest rate. So that's why our goal is to really help our clients go into the loan process with the best score possible, because that way it's going to help us get them a much better rate. Typically, one of the biggest things that we look into as well, we know that conventional programs tend to be a little bit stricter when it comes to credit issues too, where those loans with government loans like FHA, VA, USDA, they tend to be a little bit more lenient. But that doesn't really mean that someone with a credit issue should just go with that government-sponsored program, because sometimes conventional programs can be better, right? So it all depends on the criteria for the client. So when it comes to what affects that credit, right? Most clients always wonder what affects their credit score, because some of the evidence they see, it just doesn't make any sense. So the credit bureaus, they closely look at those credit score algorithms. So even the best, mathematicians out there will not be able to just figure it out. So we do know that some of the main factors that affect that credit score, although all these are important, it's just these are going to be the main ones that always have a direct impact on that credit score. So, for example, we know that bankruptcy and foreclosures are significant credit issues, and therefore they have a little bit of a higher impact when it comes to underwriting. Credit utilization is a big one. So that's one of the easiest ones to fix when it comes to that. And I always advise my clients, because when we talk about credit utilization, it's that percentage that you're using of your overall credit. So let's take an example. For some reason, we have a client that has $50,000 in a line of credit, and they're using about 5,000 of that. Well, that means that they're only using 10% of that credit utilization, which is good. Usually lenders want you to be anywhere between 20 and 30% credit utilization. Now, if let's take the same example, we have a $50,000 line of credit that a client has available, and they're using 25,000 of that. So that means that 50% of that available credit they're using, that could have a negative impact on that credit score. So that's usually one of the biggest things that we look into to sort of like start the credit line and overlooking at the whole process. Other things with good amount of impact are like payment history and credit. Closing accounts is a big one, and opening new accounts as well. Sometimes those could have an impact on that credit score. And the last one that it has again some impact, but it sort of goes towards the end is just the credit mix and the age of the credit. They play an essential role on the overall approval possibility as well. All right, so one of the questions that I get asked all the time is why isn't my online score like Credit Karma or things like that the same as the ones that we pull, right? So this happens all the time because clients usually just go based on what Credit Karma says or their credit card says. But quite honestly, this question is just similar to the question that people ask, like, why are the Zillow estimates not the same as the appraisal, right? So it's all based on the tools that they use. So online tools like Credit Karma, using a scoring method, they use the method, it's called Vantage. And the lenders use FICO. So that's the biggest difference between those two. They're different companies with different algorithms, and that's how they assess credit. So it's all the way that they sort of input that into the system. So the credit, it can really differentiate between those two. And as a lender, we have to use the credit scoring method, which is FICO, because that's the one that all of our agencies and investors always require per industry standard. So this is an important one as well. So what is a lender looking for when it comes to credit, right? So basically, they just really want to see that the client's financial profile can demonstrate a good probability that the borrower can repay the debt. That's honestly the biggest concern that they have. They're not concerned about getting that. They don't want the house. The biggest thing they want to make sure is that the ability to repay is there. If there was an issue, was it due to like a live event, such as like divorce, health issues, loss of a job, things of that nature? They take that into account. Again, we're all humans. Lenders are human too, so they always can see when a credit event has been impacted due to a live event as well. So that's something that we always sort of like are upfront with our lenders that we use to make sure that we can have the most benefit for our clients. This is why lenders will look at how long it's been since the issue or issues that happen with your credit event, because the longer, the better for both the credit score and the lender. And they also evaluate whether or not the client was able to sort of like reestablish their credit and sort of get back on track. So those are things that they all show up in your credit report as well. And it's one of the things that we really pay a close eye to make sure that we have all the information needed to come up with and present a good case to the underwriters. All right, so let's now look into some of the credit issues that I typically run into. As you can imagine, I run into just about every type of credit issue in lending. So I'm going to talk about just the ones that I see the most and some of like the highlights and how we get around it. So, real estate related credit issues such as like foreclosure, loan modification, short sales, and deed in lieu, those are like the main ones or prominent ones that we see often. And it's just, it could be a lot. So it's one of the things that we pay attention to, make sure that we rewrite our guidelines here as educated as possible. Bankruptcy judgments, liens, and collections or charge off, they may happen due to like life events, like I just mentioned before, or financial mismanagement. That's a big one as well. They all depend on, the client's profile. So of course, the underwriters will consider late payments and even consistent overdrafts and checking accounts. They took those into account as well. And finally, federal obligations. That's a big one too. Any tax liens, income tax that haven't been paid, or things of that nature. So let's dive into all of those a little bit more. All right, so honestly, the most challenging credit issues to deal with are the ones that are real estate involved, because this is the type of loan that you're applying for, right? So that's usually the biggest one that we see around. The circumstances behind the issue and the amount of time between the event and the application all come into play when it comes to the credit issues. So, for example, in a foreclosure, the lender takes back the house pretty much. So the lender now owns the home and the lender is responsible for it. So chances are good that the client has not either made payments on the house for a while, or they maybe lost a job and they just couldn't afford it, they couldn't pay taxes or things like that. So they could go into the foreclosure status for it. When we talk about modifications, it's more for people who are trying to get back on track and have worked out sort of like an arrangement with the servicing company to pay back the lender, but on a modified term. So it's just has their income or their new financial picture looks like, right? Now, I'm sure most of you are familiar with the short sale. That's a big one as well. And honestly, it's, lenders allow the homeowners to sort of like sell the property for less than the amount that they're obligated to. It could be interesting the way that they do it, because if home prices have dropped substantially, but the amount owed did not, it left people in sort of like a catch-22 situation, right? So they needed or wanted to move, but couldn't because they owe more than the house was worth. So this is what truly happened back with the meltdown in 2008. And it was a big part of the sort of like housing crash back then, because people were falling into this type of situations. And then finally, deed in lieu, it's when the lender takes back the home but does not foreclose on it. So essentially, the owner just signs the house back over to the lender, but they haven't really officially finalized their foreclosure status for that. All right, so bankruptcies, judgments, things of that nature, they may include real estate as well, but it's mainly associated with just having too much debt. Again, this could be caused by a life event or financial mismanagement or a little bit of both. So the bottom line with bankruptcies is that the lender really reviews the time frame from dismissal or discharge and whether the borrower has reestablished their credit and why it happened. So those are like the big things that they look into when it comes to bankruptcies and judgment. There are two personal types of bankruptcy. One is Chapter 13, which is a repayment plan for the client. So the debt they have can be paid back, but in a more manageable way given their financial ability, right? So that's the biggest portion for that, sort of like a negotiation that they happen with the court, with both between the client and the lender. We have Chapter 7. It's sort of like start over bankruptcy. So it really means that all your debts, including in that Chapter 7, do not have to be paid back. And the client has a clean slate to start over. So this generally happens when the client establishes with the court that they cannot pay back the debt owed. And once a bankruptcy is dismissed or discharged, the client's wait time, it really depends. It's generally around 1 to 2 years for Chapter 13. But if we're looking at Chapter 7, we're looking more like a 4-year waiting period. So it just really depends on the program time and the reason, mainly for the bankruptcy. Now, where things really start to fall apart are multiple bankruptcies. So most lenders know that something that can, happen to blow up in your life at least once. Yet when it comes to more than once, that's when things just don't go as planned sometimes. And they make you wait a little bit longer, sometimes up to 7 years after that bankruptcy has been discharged or dismissed, in order for you to reapply for a loan. All right. Let's talk about judgment. So essentially, a judgment is when the court has ruled in favor of the lender or the person requesting the judgment, and the borrower must repay the debt. So simple as that. They have to pay that money back. It could be either a lump sum or it could be a monthly payment, but it has to be satisfied at the very end. When we talk about liens, it's mainly a debt that's filed against a person or a property. So it could be either or, which gives the person filing the lien the right to possession of the property until that debt is satisfied. So they just put a lien on it. For example, if you're familiar with like a mechanicals or mechanics lien, a security interest entitled to a property for benefit, things of that nature, that's what we think about when we talk about liens. Other types of derogatory credit are collections, charge-offs. These are big ones as well. Disputes, we see those very often when we pull that credit report. This type of issues, though, can cover many things, such as, it could be like car loans. Those are big ones that I see. Medical bills are big, big ones that I usually see in collections. Credit cards as well. They, people can let those go and the type of issues, if you will, it's not as impactful as a bankruptcy. So that's at least good. Those are things that we can work off with the borrowers directly, and then we can resolve much quicker than if they were going through bankruptcies and things of that nature. All right, so because mortgage lenders request bank statements, they will see the payment patterns of a person's checking account. So even though there might not be any reported credit issues, this is a big one that I always try to be upfront with my clients. An underwriter can really look at the number of like overdraft accounts in their checking savings, things of that nature. So even though they don't report directly to the credit bureaus when you overdraft your account, it just doesn't show a good face, if you will, in the eyes of an underwriter. So that's something that we always keep an eye out for, make sure that our clients have the accounts on time, everything is paid up to date. Um, Late payments are a big concern as well. So if the credit report shows a person's payment history on a reported debt, but that is often not reported correctly or late, that could impact an approval. It could be bad for our approval intended purposes on our end. So it's something that we always keep in mind when it comes to it. It sounds simple, or it sounds like, hey, it might happen once in a while. And it's all about explaining and then making sure that our clients are aware. All right. And then the last thing that I wanted to cover with you today is just, extreme circumstances, because this is a question I get asked a lot. Doesn't seem like, you know, nobody's exempt in life from life events. It just really happens to anybody. As a lender, I've seen some situations that would break your heart and others that make you just like shake your head. So you really see a mixture of the two. But the people that approve our mortgage loans have also seen it. So it's one of the things that, if clients have gone through really bad situation, but we have a good way to explain it or paint the picture to our underwriters, it could really be an opportunity for us. So it's all about communication, and just being a true partner with our referral partners, of course, but also our lenders that we work for. When a lender is looking at credit, they mainly just want to ensure that there was a reason other than I didn't feel like paying my bills or decided to go on vacation versus paying my bills, right? So those are one of the things that they just want to make sure that we're accounting for. So everybody just needs to understand that these things can really happen to any of us. But one of the biggest things is like working with us, we're like a no judgment zone. So we always take care of looking at the overall picture and making sure that we're advising the clients the best way that we can to make sure that they can succeed. And that is all I have for you guys today. Thank you so much for joining me. Hopefully this was informative and you had some good information or, doubts that you had answers to in this webinar. So thank you again. And if you have any questions or need any further clarification, here's my personal information. I'm always happy to do consultations with my clients and then go over different scenarios, because let's be honest, everybody has different experiences and everybody goes through different things, right? So this is not going to apply just to everybody. Everybody's going to be different depending on their financial profile. So I'll be more than happy to help. Again, here's all my contact information. Thanks so much for joining us today, and we'll see you again next time.